so many investors lose money because they prioritize their emotions over profits. NASDAQ had its worst day since 2022 as tech stocks get slammed. I gotta sell my stocks. Or if it's not the world ending, you'll hear something like this. The Dow Jones jumped 200 points to hit an all-time high. Buy, 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 buy. By the way, those two articles were published within minutes of each other on the exact same day. Here's the thing, CNBC, Yahoo Finance, Wall Street Journal, these are media companies. They're not financial advisors. And you gotta stop making your investment decisions based off of what media companies are saying. I know this because I run a media company. And guess what? Media companies work very differently than investment advisors, and what I want you to do is understand the difference between investing education and understanding what's happening in the markets. Over the last 100 years, we've seen the markets move something like this. Obviously, this is not an exact depiction, but something like this where we've seen booms and we've seen busts. But besides the booms and busts, we've seen the markets grow overall over the last 100 years. But do you know what ends up happening when you look at the news? Anytime you start to see one of these downturns, you hear that the world is ending, you need to sell, you got to get out while you still can because things are going to get bad and they're only going to get worse. And this creates a lot of panic, it creates a lot of fear, and this gets people scared, and so they start selling. And then when people start selling, well, then more people start selling because then they see the stock price fall even further. You create the self-fulfilling prophecy and the people get more scared, which then causes markets, stock prices especially, to tank. Because remember, the stock market is emotional. You can buy and sell a stock in an instant. It's not like real estate. I mean, if I wanted to sell a piece of property, it's going to take me a few months to get this property listed, sold, and completely done with. But with stocks, if I see a headline and I get scared and I sell, I can do it in a second, which is what can create that panic and create that fear. But it's the same thing on the other side, because then when you hear, oh, this stock is doing great, you don't want to miss out, this is booming, everybody's getting rich, you have to come in and buy now. It gets people excited, and then they start to buy. And why are people buying? Well, you're buying because you heard your Uber driver make $10,000 off of this one trade, and you want to make that $10,000 too, so then you come in and buy, which then pushes the stock higher and higher and higher, and then you find out that it becomes overinflated, and then it starts to come down, and now you freak out because the stock that you thought was great, this investment that you thought was great, starts to fall a little bit. Now you think, why is it that every time I make a stock purchase, it starts to go down as soon as I buy? You've heard people say, buy low, sell high. But what ends up happening to so many people is they end up buying high and selling low, because instead of trading or investing on financials, they're making investment decisions on emotions. And that's one of those things that you're going to have to stop if you want to build wealth, especially in something like the stock market. Now, I want to remind you that on August 15th, 1971, the United States dollar was taken off of the gold standard. And because of that, this year, 53 years later, on August 14th and 15th, I'm hosting a live, free, and virtual investor summit where I'm going to be going over, number one, how money has changed over the last 5 decades and over the last 5 years. But even more importantly, number two, I'm going to be going over how you can find unique investment opportunities in today's economy. With money changing, with the slowing economy, with high inflation, with high interest rates, how can you continue to find investment opportunities? Well, I'm going to be going over that deep on August 14th and 15th. If you'd like to join me, it's free. All you got to do is register using my link down in the description below. But let me tell you why it's so difficult to actually be able to buy low and sell high. Because if you wanted to actually come in and buy here when prices are low, people will tell you that you lost your mind. People will tell you you're buying something into bankruptcy. People will tell you that you are a fool to buy something when it's down. But when you buy something off here, now everybody will tell you that you're buying the next big thing. You're buying the next hot thing because it's been booming and it's going to continue going up and up and up. But nothing can go straight up forever. Likewise, if you come and sell up here, if this is the time where you're taking profits, people will tell you you have paper hands. People will tell you that you're stupid to sell right before the big boom. People will tell you that you're dumb for taking profits before we really saw the big gains. See, it's this big psychological game now because of the internet that people want to justify their investment decisions based off of what's happening on Reddit, based off of what's happening in the social communities, based off of what's happening with news companies and other media companies. And this is where I want you to take a step back and remember, their investment decisions are not your investment decisions. It's your money, your decisions. Stop letting a random person on the internet or a random guy on YouTube telling you how to use your money. It's your money, your decisions, and I want you to be smart here, build that financial education, and understand what is your investment goals? Because there's a lot of people who say that they're investors or who say they want to be investors. But as soon as you get a little piece of bad news, you turn into a trader because now you hear something bad's happening. You see this thing that you purchased go down by 4, 5, 6%. You freak out and then you sell because you got scared. But this is where you got to start cutting through the noise and remember, what is your goal as an investor? Because the first thing, what does it mean to be an investor? Well, if we look at it from a legal perspective, you got to be investing for at least a year because the IRS tax code is going to tax you differently if you own an investment for more than a year versus less than a year. If you own an investment for less than a year, it's considered active income. This is ordinary gains, short-term capital gains. Versus if you own it for more than a year, it's considered more investment income and it's considered long-term capital gains. So if you own a stock for more than a year and you sell it for profit, you get long-term capital gains, lower tax rates. If you own a stock for less than a year and you sell it for profit, you pay ordinary tax rates. It's called short-term capital gains because the IRS doesn't look at you like an investor. They look at you like a trader, somebody who has a job of trading stocks. So just from a legal tax perspective, you're not considered an investor unless you plan on at least owning your stock for a year. But now from a financial perspective, you want to hold on to your investment for a long time. A lot of investors don't think about how can I sell this in 1 or 2 years as an investment. They're thinking about how can I hold this for a long time because that's where you're going to see the big real growth. So we're talking about years, sometimes decades to really see the big growth because that's where you're going to make the most money. Now you might say, well, Jaspreet, if I have to own a stock forever, how do I make any money? Well, you can also make money through dividends. Because if a company starts to grow and it starts to make more money, they can also start to pay out bigger and bigger dividends, which means you can get paid without having to sell your investments. But you got to remember, it's a completely different mindset to think about, I want to own an investment for the long term versus I want to make a quick buck. And this is where you have to be the one to make that decision and understand what is your goal. Because if you want to invest in individual companies, which I recommend 98% of people should not be investing in individual companies because you got to understand how to listen to earnings calls. You got to understand what is a 10K versus a 10Q. You got to know what's the cash flow statement, a balance sheet, and an income statement. You want to understand how to value the company and how to value the stock, which is great for 2% of people, but for 98% of people, they have no idea what that is or they don't want to do that. And so then you're just picking random stocks, hoping that you're going to make money. But then you get bombarded with the media telling you that things are great or that things are crashing. And it's very easy now to get emotional. And so there's two parts to really investing your money. You got to have the financial aspect, but you also got to have the psychological aspect. Both of these are so important because if you get caught up in the emotions of investing, well, you're going to fail. Because you're going to see these roller coasters happen and then you're going to be the person that's selling low and buying high, which makes somebody else rich. And if you want to be the person that's making yourself rich, you have to understand the psychology and the financials because investing is tough. Now, one way to kind of bypass a lot of this is just to do a simple passive investing strategy where now you're buying every week or every 2 weeks or every month. You find a nice fund, a nice index fund, a nice ETF, a nice mutual fund. And now you buy, buy, and you do this for a long time. Now what you're looking to do is just accumulate more and more and more. This is called dollar cost averaging, and you buy your way when markets are going down, you buy your way up when markets are going up. The only change that you would make is when markets go down, this is where you come in and buy even more aggressively. Buy even more aggressively. But you don't change the strategy based off of what's happening in the markets. You don't change the strategy based off of if it's raining outside or if it's not. You do this consistently week after week after week, month after month after month, year after year after year, decade after decade. That way you can build real, true wealth. Because now you're investing your money into a fund instead of just one company. This fund might have 500 companies in there, or 2,000 companies in there. And then if one of the companies in your fund goes bankrupt, well then the fund will kick that company out and put another company in. Now there is some research involved to figure out what's the right type of fund. I mean, do you want to invest in an S&P 500 fund, which is the top 500 companies, the 500 largest companies in the stock market? Is it a total stock market fund? Is it a dividend fund, a healthcare fund, an AI fund, an emerging markets fund, a real estate fund? I mean, there's a lot of different types of funds out there. But if you believe in the industry that you're investing in, because you got to understand the trends of what's happening in the financial markets, that's where now you just keep funding it and let the markets do their thing. Warren Buffett says that time in the markets beats time in the markets. And the reason why is because when these things happen, most people don't know that this is the time to buy. They don't know that this is the time to sell. And I have seen this firsthand. When the 2020 pandemic hit, markets were doing this. They were crashing. And I was talking about how I was buying here, I was buying here, I was buying here, I was buying here. I didn't know when the market was going to bottom. Nobody knows. And when I would make videos talking about how I'm buying, people would get very angry, talking about why would you buy stocks when the market is collapsing? Why would you buy stocks when everything is going down? Why would you buy stocks when the economy is going to go to crap? Well, we saw what happened with the markets. We saw the markets break brand new record highs again and again and again after that. The same thing happened after the 2008 crash. Real estate prices tanked. And so I was naive at this time. I'm not saying I was any genius when the 2008 crash happened because I knew nothing about money. I knew nothing about investing, but I started investing because I just got lucky with time. And I started buying. And I remember telling people, because I was in college at this time, that I wanted to start investing in real estate. And I started telling people who had money, people that were more financially savvy than I was. Everybody told me that I was the dumb one because I wanted to buy real estate when it was selling for 90% off. Because real estate didn't create wealth then. Real estate created foreclosures. Real estate created bankruptcies. That was the whole perception around it. See, it's very easy to get caught up in the emotion, in the panic, in the fear. But you got to remember, investing is the financials and the psychology. And if you want to be a successful investor, you got to master this, which is the financial education, but also your psychology education, which is how do you stay calm when things get tough? Because guess what? Things will get tough. When? I don't know. We know that a recession has happened every decade for the last century. It's a fact. We know that another recession is going to happen. And when the next recession happens, guess what? People will panic. People will freak out. People will say, this time is different. Well, we know that this has happened before. And this is why I like to say what Ray Dalio says. History doesn't exactly repeat itself, but it does rhyme. And so if you want to be able to build wealth, if you want to be a successful investor, you've got to be able to cut through the noise. Learn how to use the news, not get abused by the news. That's one of the reasons why I created Market Briefs, because it's a newsletter that breaks down what's happening in the financial news without all the sensationalism, because it's all in one email. See, where most traditional media companies, the way that it works is you have to create an article that gets clicked on. And if the article doesn't get clicks, well, nobody sees it, and there's no ad revenue given to the media company. So a media company is incentivized to make something exciting. What is exciting? That nothing's going to go down, that the markets are booming and people are getting rich, or that everything is crashing and you got to get scared and get out now. That's exciting. That drives clicks, which then drives ad revenue. But this is where you got to understand the game. That's how it works on the internet. I mean, hate it or love it, that's what happens. If I make a video on YouTube and the title is not interesting, the thumbnail is not interesting, guess what? YouTube takes that video and they put it in the YouTube graveyard. Hate it or love it, that's what happens. That's one of the reasons why I've been so adamant on building Market Briefs, because it kind of breaks through all that emotional side of things and it just gives what's happening in the news in an unbiased form. But this is where I want you to understand how the internet functions, how the media functions, how emotions function, because if you want to be a successful investor, you got to separate the psychology and the financials, and you have to be able to master this and master this in order to make smart investing decisions. Because guess what? Markets go up and markets go down. And there's a saying on Wall Street that goes, bulls make money, bears make money, pigs get slaughtered. A bull is somebody who believes the market is going to go up. A bear is somebody who says the market's going to go down. Pigs are people that get greedy. These are the people that get caught up in all the emotion. They don't know what's going on, and the pigs are the ones that end up losing money. And unfortunately, most investors are pigs. And if you want to build wealth, you got to understand the way that the game works, that we don't caught up in the emotions. Now, of course, if you're investing your money and you figure out, oh no, this thing that I'm invested in is on the verge of bankruptcy, that I no longer believe in this investment, it's no longer a good investment, then yes, by all means, get your money out. But there's a difference between panic selling and selling because this is the right thing to do at that time. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money, which is why I always say, do your own due diligence and never blindly trust a random guy on YouTube. But understanding this is the name of the game. If you want to win in the game, understand the psychology, understand the financials, because guess what? Everybody will tell you your financial education is important, but no one tells you the importance of your psychological education as well, because you're going to go through the highs and lows. And when those things happen, you got to be able to cut through the noise, because bubbles make everything look like a good investment. Everything looks great when it's filled with hot air. But then when it busts, everyone says, oh, that was obviously a dumb idea. But then you want to be able to find the opportunity. That's how smart investing is done. And again, if you'd like to join me on my free investors workshop, I got that link for you down in the description.
Not paying taxes. When you pull money out of your 401k.
You weren't charged taxes while it sat there. What's wrong with you?
401ks are the most popular investment vehicle in the United States, but the studies show that most Americans have no idea of how they work. But that stops today, because I'm going to be going over 5 things you need to understand about your 401k